Now that we have our MACD, interest rate sensitivity measure, let's convert that to two different measures that capture how interest rate changes actually affect bond prices. So the impact on the price of the bonds or the value of a bond portfolio. So these two measures are ModD, modified duration, and DV01, which is the dollar value of a basis point. Okay. All right, so the big question is, how does a change in yield to maturity affect the bond's price? And both of these measures will use MACD, will build on MACD, our interest rate sensitivity measure. ModD is something very specific. It measures the percent change in the bond's price in response to a 1 percentage point change in its yield to maturity. So imagine a 1 percentage point shock, up or down. What will happen to the bond's price in percentage terms? Okay. Both of these measures, both ModD and DV01, will be only approximate. These are approximations. These are not going to get precisely the correct answer. But when you are working with, say, a large portfolio of lots of things, lots of different bonds with lots of different maturities, this is going to be close enough. It's going to save us a lot of time to be able to use these measures, even if it comes at the expense of a little bit of accuracy and precision. The second measure that we're going to use is a little bit finer, in the sense that it is not going to look at a 1% change in yield to maturity, which is a huge change. Normally, bond yields will move at smaller increments in general, like on a daily basis. So this one focuses on the effect of a 1 basis point change in yield to maturity. So 1/100th of a percent, 0.01%. And it will also look at the dollar impact, not the percent impact like ModD, but the dollar impact of a basis point change in yield to maturity. So as I mentioned, if you're looking at like a single bond, you don't need to use these measures. We're going to use them as examples, but in real life, we don't need these measures, right? You can just change the yield to maturity and reprice the bond, and you're going to know the answer precisely and correctly. But these are going to be useful when you cannot do it, when you have so many bonds in a portfolio, and hopefully if you know its duration, then you can very quickly figure out how much risk you're exposed to due to interest rate changes. So let me show you some examples of how these are used before we go crunch the numbers. Let's start with this one. A lot of you will eventually start investing in bonds if you don't already have bond investments. They are an important part of investment portfolios. They bring significant diversification benefits. And one way of investing in bonds is to do it directly and buying individual bonds, which is not always very practical, because especially in the bond world, these bonds tend to be pretty large amounts. So usually most investors will instead invest in funds that invest in bonds, so diversified funds. So here's an example of that: Vanguard Short-Term Treasury Fund Investor Shares. So as the name suggests, this bond manager is investing only in short-term treasury securities, investing in a bunch of them, and you can buy one or some shares of this fund, and you will be part owner of a large diversified portfolio of bonds. So short-term government bonds, expense ratio of 0.2%, that's pretty low. We're going to talk more about those expense ratios when we get to stocks. Minimum investment is $3,000. Let's see what you would be buying. The whole portfolio, the whole fund is invested in $9.3 billion worth of bonds. And there are 147 different bonds in it. So that's the beauty of these funds as investment vehicles, is you just buy a few shares, and it's as if you're holding 147 bonds. In exchange for, of course, that fee, 0.2% expense ratio. Now, so here's where duration is really important. This number you see here, average duration, that's the ModD. That's the ModD of the entire portfolio. So this gives us a very good idea about how much interest rate risk we would be taking by investing in this bond fund. So 2.2 years of ModD means if, for example, interest rates were to go up 1 percentage point, the value of this portfolio would drop about approximately 2.2%. Okay, so 1% increase in yield, ModD is 2.2. The drop in the value of the portfolio would be about 2.2%. So that would be the type of risk we would be facing with this portfolio. And you can see, because this is a short-term treasury fund, treasuries already have low interest rates because they are pretty safe. On top of that, this is short-term, as we're going to see. This makes a big difference. The average yield to maturity of this fund is 0.3%. So this is what you would be expecting as your average annual returns from buying this fund. Why is it so low? Because you can see its interest rate risk is so low, 2.2 years, so ModD of 2.2. You're not taking on too much interest rate risk. So your returns as a result will not be very high either, right? No pain, no gain idea, risk reward idea. All right, so that's that. Now let's look at Vanguard has a long-term treasury. So for those that are a little bit more risk tolerant in terms of exposure to interest rate risk, can invest in this long-term treasury index fund. So this one has 58 different bonds in it. Total value of the portfolio is $5.2 billion. And you can see average duration is 18.7 years. So this is much more. So there are a bunch of like 30-year treasury bonds in this. And this means 1 percentage point increase in yield to maturity would mean approximately 18-19% drop in portfolio value. So much more significant, right? So you're exposing yourself to a whole lot more interest rate risk. But as you can see, yield to maturity of these, when you look at these 58 bonds and take sort of like a weighted average of the yield to maturities, you're seeing 1.3%. So higher interest rate risk, higher yield to maturity, your expected return is higher. You can go even further. Vanguard Extended Duration Treasury Index Fund. They're long-term government bonds. You can boost it all the way up to 24.6 years. Now you're taking a whole lot more interest rate risk. 82 bonds, weighted average yield to maturity of 1.5%. So you can squeeze a little bit more return while exposing yourself to more risk. But one thing I should clarify is, so I'm only talking about the downside of this duration, but there's potential upside as well. If for whatever reason you're expecting interest rates to decline, then the value of this portfolio will go up. And the ones with this really extended duration, they will go up a whole lot more than the values of those shorter duration bond portfolios. In fact, that's what's been happening over the last few years. Interest rates have dropped a lot. So if you look at the performance of this bond fund, it's quite eye-opening. Over the last 1 year, this bond fund gained a value of 33%. So the return over the last 1 year was 34%. Whereas if you look at the short-term treasury fund, over the last 1 year, it's not bad. It was only 4%, right? Because interest rates were dropping and short duration meant this one, short duration fund, went up much less than the extended duration. But again, these things can switch very quickly. If interest rates start to go up, the extended duration one will plummet much faster. Okay. Another use case for these duration measures is pension funds and insurance funds, insurance companies, any financial institution or investment vehicle that has large portfolios of fixed income instruments and bonds will have to be very careful about the duration because they are exposing themselves to interest rate risk. So CalPERS is the largest public pension fund in the US, managing more than $300 billion. And they are managing the retirement savings and health spending of 1.6 million public employees in California. So this is a very major investor in markets. So they have $300 billion to throw around in the stock market, bond market, private equity, venture capital, hedge funds, all sorts of stuff, foreign investments. So very diversified. But let me show you their global fixed income program statement, 100 pages of how they invest they make fixed income investments, so they're, think bonds, for example. Right here, if you search for the word duration, right, how important is it? Do they talk about duration? You're going to see 113 hits in this one document about managing durations. This is a big, very important risk management matter, because if they don't manage this well, if they don't keep an eye on this, they open themselves up to losing a lot if interest rates move against them. So this is something they pay a lot of attention to.